Hello there, welcome to a new video. I've titled this video Getting Our Hands Dirty, and the reason for that is, well, so far we've been seeing some theory concepts, we've gone through the basics of what Forex actually is, and some basic definitions every Forex trader should be familiar with. In this video we are actually gonna narrow it down to the actual trading part of Forex, the different types of trading approach a trader can take, and all in all we are going to get much more precise. We are going to be stepping away from the theory and getting into the practical part. Okay, so let's get going. Okay, let's kick off the video by reviewing the two main different trading approaches that there are when it comes to Forex trading. Actually, not only Forex trading, also any type of trading in, well, any speculation market, be it stock trading, bonds trading. Like I say, any speculation market has, let's say, two sides to the same coin. Okay, these two main different trading approaches are fundamental trading and technical trading. I'm going to lay out the basics of each of them, then we will compare them, and we'll get moving from there. Fundamental trading, or also known as fundamental analysis, basically is what it does is it studies or analyzes the economical strength of one particular country, and depending on whether that economy, that particular country, is doing well or perhaps not so well, it will assess, it will value whether that particular currency is going to appreciate over time, or in the other hand is going to devaluate over time. Okay, at the end of the day, when you are trading Forex, when you buy a currency, what you do is just the same thing you do in the stock market when you buy a share for any particular company. If you buy, let's say 100 shares for Microsoft, what you are doing is actually becoming a little tiny owner of Microsoft. Okay, basically what you are doing is you are getting involved with that company. You are claiming ownership of that company for as much as, again, 100 shares, 1,000 shares, however many you buy. When you buy a currency, you are basically doing the same thing with its country. If you go long on the American dollar, if you buy American dollar against any other currency, doesn't matter, you are loading up on dollars. Dollars is the currency for American dollars, is the currency for the United States, and therefore you are getting involved in the American company, in the American economy. Sorry. So basically, what you are doing is you are claiming ownership, at least in a little tiny portion of the global of the American economy. So if you are loading yourself up on dollars, it's in your best interest that the American economy performs rather well. Okay, that means that the unemployment rates go down, the exports go up, etc., etc. Basically, a fundamental trader buys or sells one currency in terms of his expectations on how that particular economy is going to do in the near future. All right, that's basically what it is. He assesses the economical health, the economical situation of one particular country based on fundamentals, based on economical reports. Again, as I said before, unemployment rates, gross domestic products, public debt, exports and imports, etc., etc. And if he sees, or if he believes, if he expects that the economy is going to grow over the following days, months, years, then he will load up on that currency. In the other hand, if he believes or expects that the economy is just going to perhaps go into a period of recession, then he may sell that currency expecting that its value is going to go down. That's, in one sentence, what fundamental analysis basically is. Now, in the other hand, we have technical traders. Technical traders rely on completely different tools than fundamental traders. As we've already established, fundamental traders rely on economical reports, on economical expectations for one particular country. Technical traders care for none of that. Okay, they really don't care about external reports, unemployment rates. They don't care about that. What they do care is about the chart. Technical trading is all about the chart, and more specifically about recurrent patterns to be found within that chart. Okay, here's how it works. Here's the deal. Technical traders like to scroll back in their charts. They like to search for recurrent, repetitive price patterns, and then they like to analyze the potential outcome they've been getting out of those price patterns. So the next time that precise pattern presents itself, the next time they find that precise pattern on a live chart, on a real-time ticking chart, they know with high accuracy whether the price is going to go up or down once that pattern, as I said before, presents itself. Okay, let me give you an analogy. When you go to the doctor and you tell him, hey, listen, doc, I've got a little bit of a sore throat, headaches, fever, vomit, diarrhea, whatever. The doctor is usually pretty accurately, he's usually able to gather a quite accurate idea of what you may have according to those symptoms, right? Most of the time he doesn't really need to conduct further analysis. He doesn't need to take blood from you. Just because of the symptoms themselves, there are high chances that he will know what disorder you may have. So how does he know? How can he possibly know what sickness you may have just by listing those symptoms? Well, very simple, because it's a repetitive pattern he's probably seen. Many people have been coming to the hospital with those same symptoms in the past, and he knows that 80% of the time, whenever these, that, and that symptoms come together, the potential outcome is that you got a flu, or you got, I don't know, this or that virus, whatever. I'm not a doctor, but you get what I mean. Okay. Technical traders basically do the same thing. They study the past patterns in the chart. They pick up the key elements of every pattern, and then when that precise pattern repeats itself on a chart in real time, they know the most feasible outcome, okay, for that pattern, and therefore they can profit from the most expected outcome. So, okay, let's cut it to the chase. Which one is better, fundamental analysis or technical analysis? Obviously, I wish I knew. There is no one knows. There is no clear-cut answer to that. Some people prefer to base their trading on fundamental analysis. Some of us prefer technical analysis. Like I said, that's a $1 million question. There is no clear answer to this. However, it's usually accepted among traders that fundamental analysis is usually more suitable to long-term traders who are willing to, or who are able to, commit to one position for many months, even years. Because, as I was saying before, fundamental analysis relies on economical reports, on the overall economical situation of one particular country, and that's not something that changes overnight. Okay, we must understand that economical cycles in any economy takes time to develop. Sometimes it takes full years to quite develop. So most of the small traders, most of the individual traders, such as you and me, we are not quite prepared to commit to one single position, to one single trade, and to keep it open for many months to come, many years to come. Okay, in my opinion, fundamental analysis fits better, bank traders. It fits better fund managers. People who invest millions and millions of dollars into into every single position, and they don't mind opening a trade and keep it open for the rest of the year, because they don't see it as a trade. They see it as an investment, as a long-term investment. It's a typical mentality of buy and hold. Like in the stock markets, you believe XYZ stock, XYZ company is going to perform well over the following years. You believe it's a solid company, and well, you buy shares for that company, and then you keep those shares for many years, because you believe it's a powerful economy, and it's a good way to keep your investment, to invest your savings, if you will. Well, I believe fundamental trading is probably more suitable to that kind of people, to that kind of traders. Again, for us individual traders who, well, most likely are not gonna keep any trade open for more than few days, few weeks, perhaps no more than 1 month. Trading beyond the 1 month scope is already very long term for us small traders. I believe technical trading, trading off the charts, taking our trading decisions 100% based on chart patterns. I think it's the way to go. I'm not saying that we should not care about fundamental analysis. I'm just saying that it's something we should not base our trading decisions on, just because the time scope is not the right one for us individual traders. It's just too long of a time span. It's too long of a time scope for us, and just doesn't fit our trading goals, our trading approach, our trading methodology, which is going to be open, which is going to be to open and to close trades within the day or within the week, at any rate within the month. Okay, nothing farther than 1 month. So yeah, I believe technical trading is the way to go. That's what I'm gonna teach in this website. This is what I'm gonna teach in this course. Well, quite frankly, is the type of trading 95% of small traders conduct. So yeah, focus on technical trading, focus on your charts, focus on repetitive price patterns, and you will be on your way. Okay, let me pull out the real Forex chart. In this case, is the Great Britain pound against the American dollar, the sterling pound against the American dollar. I just want you to to have a graphical picture of what this type of recurrent patterns may look like. Please bear in mind, this is not a technical analysis training video. It's not the purpose of this video. Don't you worry, you have plenty of technical analysis material on this course, in future videos and future modules. For the time being, I just want you to see, to have an idea of what we are going to be searching for as technical traders. Please take a look at my screen. This is clearly an uptrending market. Price is clearly moving up, but it's not doing so in any chaotic fashion. In fact, if we take a close look into the chart, we can easily identify a recurrent pattern. In fact, it's a repetitive swinging or waving pattern. Take a look at my screen. You see that? You see how price is waving, swinging in the direction of the trend, meaning upwards. This is the type of patterns technical analysis search for. So the next time price shows a similar trend information, by analyzing the past, they can search for the the optimum buy levels and obviously also the optimum sell levels. So, they can maximize their trading opportunities by, first of all, analyzing how price has behaved in the past whenever this type of trading scenario has happened, and second, exploit the fact that price usually follows a repetitive pattern. Okay, if price, as you can see, does or is moving in this waving fashion, next time it is to be expected that next time we see another uptrend, price may behave in a similar way. That sort of gives us an edge, an advantage over the market, and we're going to try to exploit that market, that edge, that knowledge, that repetitive pattern to squeeze a profit out of our technical analysis. Okay, so we've just seen the differences between technical and fundamental analysis. We've just seen the key characteristics of each of them, and we've also established that most of the small traders, most of the individual traders remain on the technical field in order to determine or base their trading decisions. Now, another way of categorizing those technical traders, those technical analysis traders, is as per the time scope, the time frame they are basing their trading decisions on. Technical analysis can be applied to multiple time frames. It's equally valid if you are a very long-term trader, and also if you're a short-term trader, even an intraday type of trader. The basic principles of technical analysis doesn't quite vary whether you are a short or a long-term trader. Like I said, the basic principles remain pretty much the same. The only thing that changes is the time scope. How far in time do you expect to your trades to remain open? How far back in time you've gone in order to conduct your entire trading plan, and also obviously the frequency of your trades. If you are a short-term trader, you expect to take many or multiple trades on a regular basis, even on a daily basis. If you are a long-term trader, you expect to take fewer trades, but obviously those individual trades will span much farther in time. So as far as the time frame and the frequency of the trading goes, we could establish 5 different type of traders. At one end of the spectrum, we could find the scalpers. Scalper is Forex lingo for taking multiple trades within the day that basically aim for a very, very small amount of pips per individual trade. Basically what they do is they jump in and out of the market on every every 5, 10, 15 minutes, in and out very quickly, and they just shoot for 5, 10 pips per individual trade. Very quickly they open a trade, they keep it open for 2 minutes, 5 minutes, 10 minutes, no more than that. They grab their 5, 10 pips and they jump out of the market right away, searching for the next opportunity to jump in again, another 5, 10, 3, 7 pips out of the market again, and so on and so forth. That's a very, very difficult type of trading. It's certainly not it's only for experienced traders, obviously, but it's also a very, an efficient type of trading, because remember when we were talking about before about spreads, remember the transaction cost that's implied within every transaction. Let's say you take 10 trades per day, just to shoot for a tiny amount of pips per individual trade. Well, that means that for every of those trades, you'll have to pay the spread. So it's rather inefficient. It means that every time you jump in and out of the market, you need to pay the commission cost, which in Forex is quite small. Okay, trading is not so expensive when it comes to transaction costs in Forex, but I mean, if you are taking 10 trades per day, those small commissions, those small spreads, they do add up at the end of the day. So first of all, scalping is very difficult. Second, is rather inefficient in my opinion. So for the time being, it's better if we just leave them for if we just leave scalping to the to advanced traders. Okay. Now, in the other end of the spectrum, we can find investors. These investors, they take trades that could easily span for a year or for multiple years. As we were explaining on a previous video, this is the typical mentality of buy and hold that was so popular in the stock markets throughout the 80s and the 90s, when we saw that beautiful rally in the stock markets, between 1981-82 all the way up to 2000. The stock markets never stopped going up, never stopped climbing up, and it was very popular, the buy and hold mentality. You buy one stock of any company that you find solid enough, that you find reliable enough and trustworthy, and you just hold those shares for multiple years, because, well, we are going through a rather benevolent market, let's say. Now, again, this type of trading, very, very, very long-term trading, is not really the type of style for small traders such as us. It's just too long of a time span. This is more, this is better suited for investment banks, for institutional traders, for fund managers, people who need to manage a portfolio and who don't mind to find a good buying opportunity in the market, and then they just keep it open for multiple years because, it's yielding a good result in the long term. But for us small traders, perhaps it's not the most appropriate type of trading. So we've established that scalping is for advanced traders. The investment type of trading is for another type of traders, not for speculators, but rather for investors. So we are going to be focusing on this type of trading approaches. First of all, we have intraday trading, which is basically taking one trade per day or one trade most of the days. Now, that's just one trade per day because, if you take multiple trades per day, then you'll be scalping. You will not be intraday trading anymore. Basically, intraday trading or intraday traders open and they like to open and close the trade within the trading session. There's nothing that an intraday trader hates more than holding a trade overnight. They want to get into the market, squeeze their profits, close the trade, and to be done for the day before the trading session closes. Okay, so to sum it up real quickly, just one trade per day, and to make sure you are out of the market by the time the trading session ends. Okay, next one up, intra-week trading. Basically, this is taking one or two trades per week. Again, no more than that, because otherwise you would be taking one trade almost every day, and that's intraday trading. So intra-week trading means taking about 1-2 trades per week. And those trades, they may indeed remain open overnight, but at no rate they remain open throughout the weekend. Remember at the beginning of this introductory module where we established that Forex is a 24/5 market, meaning that's open 5 days a week, 24 hours a day. Well, that's because, as we were establishing, the Forex market closes for the weekend, and intra-week traders certainly don't want to hold any trade from Friday to Monday. Okay, they want to make sure that whenever they close the shop for the weekend, they've closed out all their trades, and they are done for the week without having any position open. Okay. So, again, to sum it up, 1 or 2 trades per week. They may remain open overnight, but not through the weekend. And Finally, we have long-term trading. I'm not very sure I picked the right term here. Long-term trading. Long-term trading should be it's more related to investment. Let's call this intra-month trading. Okay. Since we've been using intraday and intra-week terminology, let's use this. Let's change this actually for. Let me edit this real quickly. Intra-month trading. There you have it. Okay, intra-month trading, that's pretty much the same as intra-week trading, but just spanning the time span, the time scope further in time. Basically, taking 1, 2, 3 trades per month, no more than that. Otherwise, again, you would be closer to intra-week trading. So you want to take 1, 2, 3 trades per month, and you can indeed hold the trades through the weekend, but you don't want those trades to remain open for more than 1 month. That's if you keep a trade open for more than 1 month, that's already way too long in time. You would begin to feel uncomfortable with that position, and that's never a good idea to be uncomfortable with your own trading. So cherry pick your trades. One trade, 2 trades per month, 3 trades maximum, and never to keep them open for more than 1 month in time. Okay. So, having taken this one out of the equation for being only for very advanced traders and being rather inefficient, and this one as well out of the equation for being more suitable to large traders, well, the question remains, which one is better out of these 3? And of course, as usual, well, there is no clear-cut answer to that. Every trader will have his or her own preferences. But what I can indeed tell you right now, is that intraday trading is only for those who are able to trade full-time. Let me try to explain myself. Since intraday traders seek to open and close the trade within the trading session, and furthermore, they seek to trade on a daily basis, meaning 1 trade per day. That requires time. I mean, that requires a lot of screen time. It requires you to monitor your charts and your trades in real time, rather often throughout the day. Since you always need to be ready to, pull the trigger, jump into the market, and then, once you've scored your profits or your losses, you never know, hopefully your profits, you need to be ready to jump out of the market again. So if you have a full-time job, if you have family commitments, whatever it is, if you cannot dedicate full-time, at least, I would say, 4 or 5 hours per day to your trading, I would pretty much say you will have a hard time being able to, catching up with intraday trading requirements as far as the time goes, okay, as far as dedicating time enough in front of your charts. That's why I can only recommend intraday trading for all of you guys who want to dedicate yourselves to trading. Full time, okay? No other full-time commitment throughout the day, because trading in itself is going to be a full-time commitment for intraday traders. Now, intra-week trading obviously also requires time. It also requires, quite a few hours of screen time. But that's on a weekly basis, not on a daily basis anymore, on a weekly basis. This could easily be compatible with having a full-time job, and maybe might be a more time-friendly type of trading for all of you guys who are, who have other things to take care of throughout the day. I would say that intra-week trading with perhaps 1 hour a day should be more than enough to keep up with the trading needs, with the trading requirements. 1-2 hours a day, yeah, that should be more than enough. Now, if you have a full-time job, if you can only dedicate, let's say, 1 or 2 hours a week to trading, perhaps only on the weekends, or perhaps half an hour on every evening, once you come back home after after a long day working, maybe you may want to start off by intra-month trading. Maybe uh, it might be better. You might be better off by, for the time being, leaving these two aside. I mean, intraday and intra-week trading, and focusing at least at the beginning until you get the hang of it. For the time being, to try to cherry pick your trades. In order to to take one or two, three trades per month without the rush, without the stress of having to close them within the day, or even within the week. Allowing yourself a little bit more of breathing room, and therefore being able to keep them open for multiple weeks, multiple days. Probably at the beginning, at least, the most time friendly type of trading for all of you guys with full-time jobs and families, and let's say a busy life out of forex trading. I'm not saying you cannot intra-week trade. Okay, I'm not saying at all. In fact, any of these two is a good beginning. Certainly intraday trading is not, I repeat, it's not a good beginning, or an appropriate beginning if you have a full-time job. I would pretty much recommend you to forget about intraday trading if you have all the requirements, all the time heavy requirements throughout the day. Any of these two would fit the bill, and that's where I recommend you to dedicate your efforts, at least at the beginning. By any means, if you are planning of becoming a full-time trader, then sure, go ahead and give intraday trading a go. Okay, just make sure you understand that you'll have to dedicate quite a few hours per day to monitor your charts in real time even. Okay. By the way, I really want to stress on something, because it's a pretty standard misconception, and quite frankly, it's totally false. It's just not true at all. So I really want to stress on something. Just because you may take more trades more often and more quickly by scalping or intraday trading, that does not mean at all that it's a more profitable way of trading than intra-month or intra-week trading. Okay, that's not true at all. And here's why. Scalping, as we've already established, you are looking for trades, searching to score 5 pips, perhaps 10 pips per individual trade. You will take multiple trades per day. And, well, like I said, multiple trades, but very tiny, each of them on an individual basis. So, okay, intraday trading, perhaps you are looking to trade as an average once per day, and then you are searching for one trade, netting you plus 30 pips, perhaps, maybe plus 40 pips, something around there. One lucky day, maybe you'll get plus 50, but that's about it. Now, intra-week trading, you're looking to trade 1-2 trades per week. Each of those trades will be searching for, will be shooting for plus 100 pips in profit, perhaps plus 150 pips in profit. Obviously, the longer you keep a trade open, the more chances the potential profit gets larger and larger. Okay, that's very obvious. If you keep in scalping, if you keep a trade open for only 2-3 minutes, price cannot really move that much in 2-3 minutes. Okay, you are gonna be searching for plus 5 pips, plus 10 pips. If you look to keep your trade open for a few hours, then you are shooting for plus 30 pips in profit, plus 40. But obviously, if you if you don't mind keeping your trade open for few days, well, then you can easily fish 100, you can fish 150 pips per individual trade. And then, well, I mean, for sure, if you are looking to keep a trade open for weeks, then you're looking into the plus 300 pip range per trade of profit, even plus 400 pip range on one given trade. So what I'm trying to say here, what I'm trying to stress is that just by taking multiple tiny trades on a daily basis, or even if it's just one trade per day, that does not mean you will instantly become more profitable than if you just take 1 or 2 trades per week or 1 or 2 trades per month, because those individual trades you will indeed take will carry obviously different potential. The longer you keep your trade open, the more potential, the more profit potential. Okay, obviously, if you keep your trade open for a few minutes or few hours, you cannot expect to make as much money or as many pips per individual trade than if you keep them open for a few days or even over a week. Okay, so if you were thinking that by trading more often and more rapidly you would make more money and more profit, please take that out of your mind, because it's absolutely false. Okay, there is no correlation between how often and how quickly you jump in and out of the market and the bottom line at the end of the month. Thanks God, fortunately or unfortunately, you never know, but the only thing that matters at the end of the month, as far as the bottom line goes, is your skills. It's not your time frame. Okay, it's not the type of trading you conduct. It's just your skills as a trader. Okay, now we've already decided what type of traders we are going to become. That's technical analysis traders. And also we've decided on our time scope, the time frame for our trades. That's going to span from intraday trading all the way to intra-month trading. Well, now that we have those two characteristics in place, now that we know how we are going to operate in the market, it's time to dig into the charts. So in the next video, look forward to seeing some actual trading charts, some actual Forex charts, and we are going to get going with the meat, with the beef of this course.